get a little bit complicated, so you're going to have to pay very close attention. And let's take a story of a company which you are setting up, and let's say you put in $100 in this company as common equity, right? But now you need some more investment to get your business off the ground. You talk to another friend of yours and you ask them to put in another $100. But this friend says, I want a fixed return, no risk, or as little risk as possible. And you tell them, okay, I'll give you a 5% fixed return, and this is a bond that you gave them, right? So let's say you have bought one share of common stock yourself. We're just going to keep it very simple. Of course, companies have more than one share and companies sell more than one bond at a time. But let's say, keeping it simple, that you sold one bond for $100, paying 5% fixed return. But you still need more money. So you go to another friend and you ask them for another $100. But this time, your friend is saying, I also want a fixed return, but I want a fixed return of 6%, right? And you're thinking, okay, how do I give you 6% when I'm giving my other friend 5%? So you tell them, I'll give you something called a preferred share. Now, what is a preferred share? This company now has $300 in assets. If there was to be a loss, let's say there is a loss and now only $50 are left, right? Only $50. Well, that's too less. Let's say $250 are left. There is a loss. Or let's say $150 is left. Okay, this is going to be interesting. So there has been a loss of $150. Who's going to take that loss, right? The first person to get their money back is going to be your bond provider. They're going to get their $100 back for sure, which means now you have only $50 remaining, and your preferred shareholder is going to get a preference over you. That's why the name is preferred share, and you're going to get zero, right? Even the preferred shareholder is losing some money, but you're losing all your money. So in case of liquidation, the bondholder gets their money first. That's why they're taking the lowest return. The preferred shareholder gets preference over the common shareholder. That's why the common shareholder is getting nothing and the preferred shareholder is still getting something. So anyways, that is the concept of a preferred share. But that's not what we're going to be focusing on right now. What we're going to be focusing on is the profit. So let's say the earnings before interest and tax that this company generates from this $300, let's say in the first year, is $15. Right. So what do you have to pay to, let's call this person Mr. X, Mr. Y, and this is you. So what do you have to pay Mr. X? Very simple, 5% of $100, which is $5, right? So $5 you're going to pay interest to the bondholder. What are you left with? 15 minus 5 is equal to 10. Then you have to pay 6% of $100 as preferred dividend. So that is $6, and you're left with $4, and that is your net income. And sorry, this is your net income is this one after subtraction of interest, and there's no tax. Let's say there is no, this is a country with no tax. Let's just keep it simple so you're able to understand the concept. So your earning before interest and tax was 15. You paid an interest of $5. Your net income was 10. You paid a preferred dividend of 6. So you're left with 4. And since there is only one share, so your earnings per share is going to be $10 net income minus $6 preferred dividend divided by 1, which is basically $4. So you are getting $4. Your friend here, Mr. Y, is getting $6, right? 6% of 100, and Mr. X is getting $5. Now let's change the scenario a little bit and say that the profit is $21 instead of 15. Now what will happen? Is the interest amount going to change? Are you going to pay a higher interest to Mr. X? The answer is no, right? Their return is fixed, so they'll still get that 5%. What about Mr. Y? Are you going to give them a higher preferred dividend? The answer is no. Their return is fixed at 6%, so they will still get that $6. And what you will be left with is a higher amount, because 21 minus 5 is 16, and 16 minus 6 is 10, and 10 divided by 1 is going to be, so 16 minus 6 is 10, and 10 divided by 1 is going to be 10. So now instead of getting 4, you're getting $10, and they are still getting 6 and 5. So your Mr. Bondholder is going to be sad, and Mr. Preferred stockholder is also going to be sad, because you're getting more money than them, and you've all provided the same amount of money into the business, but you took more risk. And you deserve to get this higher return, right? Now let's bring a twist into the story, and let's say when you gave them the one bond and the one preferred stock, let's say you didn't give them just one bond, you gave them something called a one convertible bond, and you gave them a one convertible preferred share. Now what is this convertible? Convertible means that these guys can convert their bond or convert their preference share into a common share, right? Now first of all, if Mr. X is going to convert their share into a bond, the interest paid is going to be 0. Because if there's not going to be any bond, then there's not going to be any interest, right? Secondly, if the person having the preferred share, which is Mr. Y, is going to convert their preferred share into a common share, then you don't need to pay them preferred dividend, right? So now you will have 21 minus 0, which is 21, but the denominator will not be 1 anymore. The denominator will be 3, because now you have 3 shares, and 21 divided by 3 is 7. So basically you won't make 10, you will make 7, and these two will also not make 5 and 6, they will also make 7. Now what just happened? Basically, you were making 10 before, right? And now you're making 7. So this 10 was your basic earnings per share or basic EPS, and your 7 is called diluted EPS. Why diluted? Because it got diluted when the number of shares went up. So what are we really talking about over here? We are talking about your company's capital structure. What is capital structure? Where you get capital from. So equity, debt, right? Bonds is a part of debt. Preferred shares, common shares is a part of equity. So this is your company's capital structure. You can have two types of capital structure. One is simple and one is complex. Complex is the one where you have convertible bonds and convertible preference shares. These are called potentially dilutive securities. What does that mean? It means these securities can potentially dilute your EPS and make it less. And you, as an investor in this company's preferred stock, common stock, really need to be careful with issuing potentially dilutive securities because your EPS can go down. It can get diluted, right? So what are we really talking about over here? Again, let's discuss this again. Capital structure can be simple or complex. What makes a capital structure complex? The existence of potentially dilutive securities. And what are examples of such securities? Convertible bonds, convertible preferred stock, right? Let me give you another example. Companies give stock options to their management. Let's say Bank of America share price is $50 and they tell the CEO that you can buy the share of Bank of America from the bank at $60. Now obviously the CEO won't want to do that right now because he can get the shares in the market at 50. But if the CEO works really hard and takes the stock price to 80, then the CEO will come and say, okay, give me the share at 60, I will buy it from you at 60 and sell it at 80. So the board will then say, okay, we gave you the permission to buy at 60 from the bank and now you've worked very hard and the share price is 80. So you can buy the share from us at 60 and sell at 80. But the point is, whatever shares the CEO needs, the bank might have to issue some new shares to give to the CEO, and that will increase the number of shares, so the earnings per share is going to get diluted, right? So that is another example of your potentially dilutive securities, which is called stock options, right? So this is basically your capital structure, which could be simple and complex. And let's revise what we've discussed. So what are these terminologies that are important to earnings per share? Number one, potentially dilutive securities such as convertible bonds, convertible preferred stock, or employee stock options. And if there are no potentially dilutive securities, then you have a simple capital structure. If you have potentially dilutive securities, you have a complex capital structure. And a dilutive security will reduce your EPS, and that is what we saw, that it was going from 10 to 7, right? Now what about anti-dilutive? So let me just go back to our storyboard over here, and let's say that we are having a profit of 15 and they are not converting their, because interest is 5 and preferred dividend is 6, and we were having 10 minus was 4, 10 minus 6 was 4, and you had one share, and what you had initially when the profit was 15, the earnings before interest and tax was 15, your EPS was 4. Now in this situation, obviously these guys are not interested in converting their securities because they are making more than you, right? You are making 4, Mr. Y is making 6, Mr. X is making 5, so they don't want to convert. Let's look at what happens if they do convert. Obviously they won't, but let's just look at what happens if they do. So this interest will become 0, the preferred dividend will become 0, and what you will be left with is 15 minus 0 is 15 minus 0 is 15, right? And 15 minus 0 divided by 3, because they converted, will basically mean that everybody will be getting 5. So you will be getting 5, which is more than 4. So it is actually not getting diluted, it is getting anti-diluted, or therefore these securities at this level of profit are anti-dilutive. And that is what this means, that the EPS increases from $4 to 5. Obviously nobody in their right mind is going to convert those anti-dilutive securities, because why would Mr. X and Mr. Y want, Mr. Y specifically, why will they want to take 5 when they can get 6? And why would Mr. X want to take 5 when they can get 5 at a fixed return, right? Why they want to take the risk of converting to common equity? Anyways, so now let's get into the calculations. This is the formula which you need to memorize. That the formula for basic EPS is you take the net income, and this is after interest has been paid. So we started off with, let's say, 15, interest was 5, so our net income is 10. Then the preferred dividend was 6, the number of shares was 1, so we were saying that the earnings per share is 4. Now it's easy to calculate the net income because you just take the income, you subtract the debt portion if there's no tax. Of course, if there is tax, so a little bit complication can be there, but let's deal with that later. For now, let's just focus on that you know the net income, you can calculate the preferred dividend. And where is this coming from? We know that the preferred dividend was 6% of $100, and in the question they will tell you what is the value of the preferred stock, how many preferred stock are there. In our example there was just one, it could be more than one, and what is the rate that you have to pay in terms of the preferred dividend. So you can calculate the preferred dividend amount, and you can divide it by the weighted average number of shares. In our example there was just one share, so that was simple, right? We are not looking, we are not considering the dilutive situation, right? That is the calculation of diluted EPS. And let's take the other example when the profit was 21 and we were saying, okay, interest is 5, so we were left with 16 and preferred dividend was still 6, and we were coming up with a value of 10, right? But then obviously the diluted EPS would be that if it does get converted, so obviously this 5 will not be paid, right? So 21 will remain 21, right? And there won't be any preferred dividends, but the weighted average number of shares will go up because they will get converted, and here the diluted EPS was coming to 5. So we will talk about diluted EPS later, but for now I want you to focus on this denominator over here and this word which they have used, which is weighted average number of shares. In our example, it was very simple. It was one share, right? But in reality, of course, companies have more than one share. And what also happens is that during the year, the number of shares can change. So let's say in January, you have 10,000 outstanding shares. On the 1st of July, they issue 2,000 new shares. So for 6 months, from Jan to end of June, you had 10,000 shares. And then suddenly 2,000 new were issued. So for another 6 months, from July till December, you had 12,000. So your weighted average number of shares will be, for half the year, which is 6 over 12, you had 10,000. And for half the year again, which is 6 over 12, you had 12,000. So you take out a weighted average, and the weighted average number of shares is 11,000. This is the concept you need to pick up, right? Weighted average number of shares outstanding is basically the average, the weighted average, which is weighted by the portion of the year that they were outstanding. Now, there is something which we have to treat separately. So again, with the example of 10,000 and 12,000, so with 2,000 obviously new coming over here. But if there was something known as a stock split or stock dividend, then it has to be taken for the full year. Now, what does that mean? And first of all, what are stock splits and what are stock dividends? I don't know if you guys have been following the financial markets, but Amazon share was around $3,500. Google share was around $2,500. But if you will go to the market and check, it's probably going to be worth around $100 each. So has Amazon crashed from 3,500 to 100? Has Google crashed from 2,500 to 100? The answer is no. What both of them did is something called stock split, where they just split the stock. They say, okay, everybody who has, let's say, one stock of 3,500 is going to have 10 stocks, and each stock is going to be worth 350, right? So the number of shares just goes up and the price per share comes down. Why they do it? To make it more affordable for retail investors, because $3,500 is a lot of money, right? Not everybody can afford to buy this share. But if it becomes $350 or it becomes $100, then it's more affordable. The point is, when you're calculating your weighted average number of shares, if any stock split is done, so let's say if they do a 10-for-1 stock split, then that impact, even if they announce that 10-for-1 somewhere in October, it doesn't matter. Whichever month they announce it, it doesn't matter. The impact will be taken from January. It's taken from the beginning of the year for stock splits and stock dividends. But for new issues, we will take it from the date that it was announced. And let's do an example so it becomes very clear for you. And this is something we've already discussed. So what I would request is, please pause the video and try to solve it yourself, and then I will show you the solution. All right, so hopefully you were able to do it. That what's happening is you've got 10,000 shares for the first 6 months and then 12,000 shares for the remaining 6 months. So if you take a weighted average of these two, you get 11,000 shares. Now and let me just go back. The profit or net income, which means already the interest has been deducted from this, is 100,000. The dividend to preferred stockholders is going to be 22,000, right? Dividend to common shareholders makes no impact on the calculation of basic EPS or diluted EPS, because that is paid after the EPS calculation is done. That is money coming to you as the common shareholder. So calculation of your EPS is not going to be impacted by that. However, we do have to subtract the dividend for the preferred shareholders, and that is subtracted over here, which gives you a earnings per share of 7.09. Okay, now coming to the meat of this entire portion of our learning module, which is the calculation of diluted EPS. Now here you have to take the net income, let's say 100,000 from the previous example. You're minusing your preferred dividend, right? But then if your preferred stock is dilutive, if it is going to be diluted, if it is going to be converted, then that means you're not going to pay this preferred dividend, right? So you just kind of offset that by adding it back. And then if there is some bonds also which are getting converted, so then the interest you will also not pay on those bonds. So you will add back the interest as well. But this is done net of tax, and I'll just explain that why. But before I get into the discussion of why the tax element is there in interest, let me just explain the denominator over here, that you take your weighted average number of shares and you add the shares which will be new if your bond or your preferred shares are converted, right? So this is the big picture for your diluted EPS. Now let's talk about why the tax element is there. So see, basically what happens with interest is you have your revenue minus your cost of goods sold, then you have your gross profit, then selling, general and admin expenses, then your earning before interest and tax, then you have your interest, and then you have your profit before tax. So when interest is there, the higher the interest, the lower the profit before tax, and therefore the lower the tax. So interest is a tax deductible expense, which means having interest saves tax for you. And if you're not going to pay this interest because the bond is getting converted, then you will lose the tax benefit that you were getting. So we do add back the interest over here if the bond is getting converted, but we just add back the interest net of tax because we lose the tax benefit as well, right? So in our net income, we had already taken the tax benefit, but since we are not going to get it, so we add back the interest, but we just do it net of tax, which means the interest amount is multiplied with 1 minus the tax amount. So if, let's say, if tax rate is 30%, so actually if we are not going to pay this interest, then what we will save is only 70%, or 1 minus 30, 1 minus 0.3 is equal to 0.7, and the interest we are going to save is actually, or the amount of money that net income will increase by, is the interest amount multiplied by 0.7, because 0.3 will be lost in tax savings. All right, nothing like a good example to understand this concept. So what I would like to request you to do is try to do it. I know you might be feeling that you might not be able to do it right now, but it's always good to try and attempt the question, because even if you are unable to do it, when you see the solution, it will stick in a better way for you, right? So please pause the video, try to solve it, and then I'll show you the solution. Okay, so the company had 100,000 in income, paid dividends of 22,000, and you can just ignore this 12,000 common shareholders. That obviously has no impact. And then you had these 22,000 preferred shares and 11,000 common shares outstanding. Each preferred share is convertible to 2 shares of common stock. So this is the number of shares that will go up. Calculate the diluted EPS. Very, very interesting. So first of all, how many new shares will you have if it is converted? And obviously they are assuming it is converted right now. They are assuming that these securities are dilutive, which they are, because in the basic EPS calculation, we saw the EPS was 7.09, right? Which was your 100,000 minus the 22,000 preferred dividend divided by the 11,000 weighted average number of shares, which was coming to 7.9. And look how it is getting diluted now. How is it getting diluted? First of all, you take the net income, you minus the preferred dividend, but then you add it back because the preferred shares are being converted. So you add the number of new shares which are being added, which is 2,200 preference shares with the conversion ratio of 2 common shares per preferred share, and what you get is 6.5, and this is obviously diluted, right? By the way, if it was more, let's say for some reason the number of shares that were increasing, the denominator was increasing less than what was the adjustment to numerator. And let me give you an example. For example, the conversion was not 2 shares for every one, it was 1 to 1, which means the increase over here would have been only 2,200, which means your diluted EPS calculation would be 100,000 plus minus 22, so that makes no difference, plus 11,000 plus the 2,200, so that is 13,200, and 100,000 divided by 13,200 is 7.5, and since 7.5 is greater than 7.09, the answer we would write over here would be 7.09, because diluted EPS can never be more than basic EPS, right? Because in that situation, the securities would be anti-dilutive and nobody would convert them. Diluted EPS always has to be either equal to basic EPS or less than that. Here obviously it is less, and these preferred shares are dilutive, and therefore they will be converted, and the diluted EPS should be reported as 6.5. Now with the convertible bonds, obviously we need to add the after-tax interest savings to the numerator and the new shares to the denominator. Nothing like a good example to understand the concept. Please have a go at this. Pause the video, try to do it, and then I will show you the solution. Alright, so you've got your income of 100,000, right? Common shares 11,000, and these bonds are $100 bonds, 10% coupon, convertible to 5,000 shares. So first of all, what are you going to add to the numerator in terms of the interest saving? What is the interest amount? 10% of $100 per bond into how many bonds? 1000 bonds, right? So 1000 into $100 into 10% is $10,000, but net of tax. You have to take this 10,000 net of tax, 1 minus the tax rate of 1.3, 1 minus 0.3, because you're only going to get a benefit. The income is only going to go up by 7,000, not the whole 10,000, because you're losing 3,000 in tax savings, right? So your numerator basically becomes 107,000. And what about your denominator? You've got those 11,000 original ones plus new shares will be issued. How many? 5,000 new shares will be issued. So this 107 will be divided by 16,000, and what you've got is 107 divided by 16,000, that is 6.69, and that is what you see in the solution over here. Okay, naturally there is no preferred dividend, so nothing to add or subtract for that. All right, and of course, as we've already discussed, for stock options we use the treasury stock method. Now what does that mean? Basically, coming back to our Bank of America example, Bank of America, where I said that the board gave the CEO a stock option to buy stock at $60, right? The bank stock at the time was 50. The CEO worked really hard and made the stock go to 80. And then he came to the board and said, hey guys, please let me buy the shares. And let's say the stock option is for 10,000 shares, right? So the CEO will come and say, please let me buy the shares at $60 from you as you had committed to me. So the CEO will give the bank how much money? $60 into 10,000 shares is $600,000. But the bank obviously is going to have to give the CEO 10,000 shares. How? First of all, what the bank will do is they will go to the market and use this $600,000 to buy as many shares they can from the market at the market price, right? Which means 600,000 divided by 80 is 7,500 shares they will be able to get from the market. So 10,000 minus 7,500 shares is equal to 2,500 shares they will have to issue new shares. 2,500 new shares will have to be issued, because the money that the CEO is going to give is only going to be able to buy 7,500. Remaining, the bank or the company, whichever is what we're talking about, is going to have to issue. So new 2,500 shares will be issued, and that is the number of shares that will be created, and therefore we need to add that to those are the shares that will be added to the denominator. And of course, as always, nothing like a good example to make sure the concept sticks. So please, as always, pause the video, try to do it, and then I will show you the solution. All right, so income of 100,000, preferred dividends 22,000, and 11,000 common shares, 1,000 stock options, exercise price of 20, average market price of 25. So how many new shares will be created? That's the first thing we need to figure out. So if they're going to give us $20,000, because the price at which they are going to buy from us is 20 and 1,000 shares, so $20,000 they will give us, but the market price is 25. So we will only be able to buy 100 from the market, which means 200 new shares will have to be issued. So what happens to the diluted EPS? The 100,000 net income minus the 22,000 preferred. No preferred is being converted, no bond is being converted, so that is all zero, right? In the denominator only we are going to add the 200 shares, and our diluted EPS is less than the 7.09 basic EPS that we had calculated in the very first calculation, and therefore this is dilutive. And stock options obviously are always going to be dilutive as long as the market price is greater than the exercise price of the option. So here the exercise price is 20, the market price is 25. The CEO will come and say, please let me buy at 20, because obviously they will want to sell at the market price of 25, and you as the company will have to sell to them at 20, get this money, use it to buy as many shares as you can, and issue the remaining, or the remaining amount. Right. So other issues with diluted EPS, obviously sometimes securities are anti-dilutive, and therefore the EPS that you will calculate will be higher than the basic EPS, and nobody is going to convert those securities. So therefore you cannot report a diluted EPS greater than basic EPS. It's just not possible, right? So diluted EPS will either be equal to basic EPS or less than that. So how do you know that which securities are going to be dilutive and which securities are not? Well, unfortunately, there is no other way but to check it individually for each security. And how do you do that? So you take your net income and you take your preferred dividend and you divide it by the weighted average number of common shares. And then what happens is, let's say if you're talking about checking for the dilutive nature of preferred shares, you will minus the preferred dividend, you will add the new shares that will be issued, and check whether the EPS is going down or not. And then separately, you can, if you want to do it for the convertible bonds, you can add back the interest net of tax and see if it is reducing the EPS or not, right? And for your stock options, just check if the market price is greater than your option exercise price, then they will be dilutive. So how does an EPS change? Either the numerator is going up or the denominator is coming down, which will obviously lead to an increase in your EPS. Okay, we're going to stop this video here, and in the next one we're going to pick it up with ratios and common size analysis.